So what's up, guys? So today we have a special guest for the first part of the call. And like I was saying, he's somebody I learned a lot through. It's pretty funny how you meet some people in life and then find out they actually learned the same way trading you did. Met Matt through an NFT project I invested in, which ended up being the reason why you guys are all here, because that's the way me and Gio met. So Gio already knows Matt, and I really, appreciate him a lot because I learned a lot in trading through him. He actually learned the same way we learned. He started off with IM Academy and really became a key figure for a lot of people to learn how to trade, because he's teaching people all over the world actually how to trade, and he's living a free life because of that. Like, he doesn't need to worry about, oh, my job, because he literally has that skill set to make money whenever he wants, can, and will do it. He's also a funded trader. So Matt, you can just kick it off for as long as you have time, and you can also share your screen whenever you feel like it. He probably needs a sec. Hope you heard my nice edify though.
I did, brother. How are you guys? What's going on?
I'm good, bro. How are you?
Super grateful to be here, another day. So yeah, I appreciate everybody's time. I imagine you're doing well, having an amazing day, right? An amazing week, an amazing start to your year, and all that good stuff, right? So yeah, let's hop into this thing. Let's see. I'm gonna share my screen. Alrighty.
Yes, sir.
Can you see my screen?
Yes, sir.
Perfect.
So all of the guys, just to know where everybody's at, are actually kind of a little bit deeper into trading. So nobody here really is really new to trading. Most of the guys have been in for 1, 2, 3 months, already making really good progress in trading. So you can, just go on a little bit more advanced however way you like it.
Perfect. Yeah. So, okay. So we're all pretty much aware, right? There's two different kinds of trends, right? There's a bullish trend where the market's creating higher highs, right? And higher lows, right? This is a higher high because it's higher than this high. This is a higher low because it's higher than this low. This is a higher high because it's higher than this high. This is a higher low because it's higher than this low. This is a higher high because it's higher than this low, right? Also known as a bullish trend, upwards trend, uptrend, right? Think of a bull with its horns going up, like it's stuff. The bearish trend, the opposite, it's creating lower lows and lower highs, right? This is a lower low because it's lower than this low. This is a lower high because it's lower than this high, right? This is a lower low because it's lower than this low, lower low because it's lower than this high, and so forth, right? Downtrend, bearish trend, think of a bear with its claws going down, all that good stuff, right? So of course, it's very important to understand that, and could also be a part of that continuation. So first, how do you identify when a trend is shifting from, let's say, a bullish to a bearish trend? Well, the market's creating higher highs and higher lows. Whenever the market creates a new higher high, you identify that previous higher low. The market closes below that previous higher low. You could consider that a break of structure or a shift in structure. All right, so right now we're just starting off with very simple structure. We'll get into liquidity, imbalances, points of interest, distribution and accumulation, and then reaccumulation and redistribution. But we're starting very, very simple, basic term, right? So here, again, higher high, higher low, higher high. The market creates a new higher high and closes below the previous higher low. And you can anticipate this to start shifting from a bullish to a bearish trend. So now you can anticipate the market to start creating lower lows and lower highs, right? So this is bullish to bearish, vice versa, whenever the market is trading in a bearish trend, it creates a lower low, lower high, lower low, and then the market it closes above that previous lower high. You can see this going from a bearish to a bullish trend to where now it'll start creating higher highs and higher lows. So that is that. All right. Now, there is this thing called liquidity. Right now, liquidity is just money, right? That's what money is. Now, most traders, right, are trading stuff like double bottoms, right? Whenever they see, levels of support, whatever it is, they're buying here and they're placing their stop loss below. Vice versa. There's traders who see levels of resistance, right? Like a ceiling, double top, all that good stuff, and they're selling and they're placing their stops right above these highs. So that's where all their money is at, right? Now, of course, someone's winning, someone's losing. The reality is it's not a specific, it doesn't matter how much money one player puts in the markets. Price is being delivered by artificial intelligence, right? It's being delivered by AI. Of course, price is controlled by the central banks. This is very common knowledge. Those who control the information, control the world, they control the markets, control pretty much almost every aspect of most people's lives, right? So the markets are no different, right? They're orchestrated, they are manipulated in a certain way. Now, understanding liquidity is really the name of the game. Liquidity is the name of the game, right? So again, you have to really think, right? What are the known statistics? If you were to look it up, over 97% of traders fail. And it's probably like 99.9% of traders that fail. And the reality is it's because they're all trading the same way, right? Most traders are, identifying similar patterns. If you look up, like Forex reversal patterns, you're going to see a lot of the same stuff. First stuff that pops up: double tops, double bottoms, trend lines, right? All that stuff. So this is how most people are trading. It just makes sense to exploit it, right? The markets weren't designed for people to win. Markets were designed for people to lose, and the market's going to move in the direction to hurt the most amount of people, right? That's just how it is. So you have to think like that 1%. Okay, so just imagine if you were the ones moving the markets, is what we're saying here. What you'll notice, so the way we will describe it is we're really just putting like a story behind what's happening, right? Behind price action. So whenever you see, let me just go back to this, the level of support, level of, we call this liquidity. You want to see it as there's a bunch of buyers here with their stop losses below the low. Now, liquidity is used as fuel for the big players, right? So just imagine if price is going to trade to the upside, it's not just going to leave these here so everybody could win, right? The market's going to come down, it's going to take out everybody that's buying early, then it's going to go to the upside, right? Vice versa. Before the market drops, it's going to take out everybody who's selling early, and then it's going to drop to the downside, right? So you will see this, right? You want to be a part of this, and you want to be a part of this. And the good thing is, if you're not a part of it, most of the times it comes back for you, right? So this takes place, right, where there is a reversal, which is going from in this case, a bearish to a bullish, or a bullish to a bearish trend. And it also happens here when it's in a continuation in a bullish trend, and this is in a continuation in a bearish trend, right? So before we go into the fractal nature of price action, we are going to go into accumulation and distribution and understanding what's really happening, right? So see this here. Now, see this as a price scale from, let's say, 1 to 10. We'll get there, Sandy. All right, so imagine this is a price scale from 1 to 10. And this is your 50% right here. Or 5, right? 50% of that range. Now, below the 50%, you want to be looking for accumulation. Above it, you want to be looking for distribution. Now, again, whenever the market is moving in a bearish trend, it's creating lower lows and lower highs. Right? So, again, accumulation is, there's two different types of accumulation, okay? So whenever you're accumulating something, the market is going up, right? You're buying it. Whenever you're distributing something, the market is selling off, right? You're selling it, you're distributing. So there's two different types of accumulation and distribution. First one is like this, right? Where it creates lower low, lower high, lower low, lower high, lower low. It breaks structure above that lower high. It comes back and then it continues, right? This is your type 1 accumulation. The other one is whenever it creates, and again, notice how it sweeps this low and then breaks structure. Oh, you always want to see a liquidity sweep. You want to see a low get swept before it breaks and then come back and continue. Type 2 accumulation is when it's in a bearish trend. It doesn't break structure, right? But it leaves behind imbalance. And we'll get into what imbalance is right now, which I'm pretty sure you guys have a good understanding of what imbalance is already. So whenever price is trading in a bearish trend, it sweeps liquidity, gets an impulsive move into the opposite direction, doesn't necessarily break structure, leaves behind imbalance, and you get reaccumulation there. So this is your type 2 accumulation. All right. And again, your distribution up here is the same thing. It's just flipped, right? So you have your type 1 accumulation when, again, price is trading in a bullish trend. You get that break structure, price comes back and then continues to the downside. Type 2 distribution, again, notice it swept this high. Type 2 distribution is when it sweeps liquidity, right? It sweeps a high, doesn't necessarily break structure, but you get an impulsive move in the opposite direction after sweeping liquidity. It leaves behind imbalance, comes back into that imbalance, and continues trading to the downside. Now, again, this is your type 1 distribution. This is your type 2 distribution. So it's very important to understand what's happening here. So we're going to come back to this right now. Whenever the market does this, where it sweeps the low, get the break, and then it comes back and continues, this accumulation here, you want to see it like this, okay? A little story behind price action. Now imagine you have early buyers here, and again, let's just say there's another low right here. People are buying early, okay? So that means their stop losses are below this low. Now, if retail liquidity is fuel for our positions and we're like the massive players, you need a certain amount of money to fill your position, right? Like if you want to buy, let's say, you want to sell 800 billion worth of something, like there needs to be someone on the other side willing to buy that, right? So that's why, you know, the masses, you really want to see where most people are putting their stop loss, target that area, and then, you know, you tend to see the market reverse once these areas of liquidity get swept. So just imagine, right? Let's say you wanted to take price to the upside and we're in a bearish trend, lower low, lower high, lower low, lower high, lower low. Now imagine you sold 500 billion here to take out these early buyers, and then you bought 800 billion here. And your agenda, your objective is to take it to the upside, right? So you sold 500 billion here to take out these early buyers. Again, not only are there, I've got to say this, right? Whenever there's liquidity above highs, right? Not only are there seller stop losses, but there's also buy stops, right? Not only are there traders who believe this is going to drop, but there's also traders who believe once it goes through this high, it's just going to keep going, right? So they have buy stops to where when price crosses this high, they're in the buy. Also, with these lows, not only are there buyers stop losses, but there's also sell stops. There's traders who believe that once price closes below this low, it's just going to keep selling off. So once it crosses this low, they're in the sells. So understanding that below this low, there are buyer stop losses and there's seller sell stops. So what gets activated whenever this low gets swept is buyer stop losses get triggered and sell stops get activated. Now, again, let's say you sold 500 billion to the downside to take out these early buyers to activate these sell stops, and then you buy 800 billion to the upside. Not only are the people who bought early here stopped out, but now the people who have sell stops below this low are also stopped out, right? So this is what we call wiping the board. To take out both sides. Now, in this case, right, you sold 500 billion here, and then you bought 800 billion here. So your buys are in profit, but now your sells are in drawdown. Now what's happening is, again, as investors are just understanding what's, that these players are always in profit. It's like they could sacrifice capital short term, right? That's what investing is sacrificing capital short term for long-term gain. So again, buys are in profit, sells are in drawdown. So if your objective is to continue trading to the upside, what would you like to do before you continue taking price to the upside, right? You would like to at least get break even on these sells before adding on to these buys, right? So this is what we call mitigation, which is where you're reducing your risk, moving in and out of positions, hedging, right? So imagine, again, you sold, right? Again, you paid yourself on some buys, you added on to sells just to close your previous sells, right? And then you add on to buys again. So that's what's happening here. So imagine you sold 500 billion, you bought 800 billion, paid yourself on some sells, added on to some sells to close these previous sells, and then you add on to your buys, continuing to trade to the upside. Like that's what's happening here. And what you'll see whenever you get that break of structure or this huge impulsive move is you'll see that imbalance get created. Right now, imbalance is really just a huge displacement in price when only one side of the market is offered. So essentially here, this is like a big bullish candle with wicks on each side of it. So the way I like to see, describe imbalance is it's kind of like you left your house and, you forgot to close the door or if you forgot to lock a door. It's like you got to come back and close that or lock it before you take off, right? So that's really what's happening here. Like that's what's happening at a high level with these large institutions, with these players, is they're hedging in and out of the markets. They're sacrificing capital short term for long-term gain, right? Just like us. So on the other side, again, this is your distribution. We just went over accumulation. Now this is distribution. So again, you see higher high, higher low, higher high, right? Price swept this high and then it broke structure, closing below that previous higher low. So you can imagine you bought 500 billion to the upside to take out early sellers and to activate buy stops, right? People who believe once this high gets, passed, that it's going to just continue trading to the upside. So you can imagine you bought 500 billion to the upside, take out early sellers, activate buy stops, and then you sold 800 billion to the downside to take out those late buyers. So you take out early sellers and then you take out late buyers. Now, again, your buys are in drawdown now and your sells are in profit. So if your agenda, if your objective is to continue taking price to the downside, daily, what you're going to do is you're going to pay yourself on some sells. You're going to add on to some buys to come back and close out previous buys and add on to more sells, right? That's your mitigation. That's your redistribution where price again comes back in to close these previous buys that you use to take out this high before adding on to sells. So accumulation, distribution. Now the same thing is happening here, right? Which we just went over. This is type 1 accumulation and type 1 distribution. Now with type 2, right, it's very similar. It's liquidity sweep, impulsive move in the opposite direction. The imbalance gets left behind, it comes back, and then it continues, right? Same thing right here on the distribution side. Now, again, this is accumulation. This is type 1, type 2. And then this is distribution, type 1, type 2. But it's really, for me, what helped me, right? Because once you see this pattern, you see it's everywhere, right? But in reality, it's understanding what's the highest probable scenario, where to anticipate this, and how to prevent yourself from taking unnecessary losses, right? Not trading every single break of structure. And yeah, just having a little more patience and discipline, utilizing higher time frames and all that good stuff. So this is accumulation and distribution. There's also reaccumulation and redistribution. Now, just like we went over here, right? Accumulation and distribution. If this is a range from 1 to 10, above 50%, we want to be looking for distribution. Below 50%, we want to be looking for accumulation. Now, in this accumulation, right, we got that liquidity sweep. Price sweeps liquidity. It's a little penguin right there, right? So price sweeps liquidity, break structure, leaves behind imbalance. Cool. Now, me personally, I don't just execute when price comes into that imbalance, right? Because if the markets are fractal, right? So let's define fractal really quick. Right, a curve or geometric figure, each part of which has the same statistical character as the whole. Fractals are useful in modeling structures such as eroded coastline or snowflakes, in which similar patterns recur at progressively smaller scales, and in describing partly random or chaotic phenomena such as trading account growth, crystal growth, fluid turbulence, and galaxy formation. It doesn't say trading account growth, by the way. But the markets are fractals. So, meaning if we're seeing evidence, if we're seeing accumulation here, whenever price, again, if they sold to buy and they're selling to buy again, we should see the same thing taking place in here. So that's exactly what I wait for, right? I wait for price because this is a retracement, right? That's another important thing to note. Is the different market phases, right? Whenever we're in a bullish trend, we want to be a part of the expansion, right? The expansion is the move that's creating the higher high in a bullish trend. And then vice versa, the expansion is a move that's creating lower lows in a bearish trend, right? The retracement in a bullish trend, this is a move that's retracing, creating that higher low from that previous higher high before creating a new higher high. And then vice versa, in a bearish trend, that retracement is that lower low retracing to create that lower high, that lower low retracing to create that lower high, lower low to create the lower high. So understanding where you are in that market phase is important. Because here you could see, okay, we just accumulated lower low, lower high, lower low. Okay, we broke structure. Now we have this higher high, this higher low, so or this low and this high. So this could be a retracement. So if we have this in mind that this is a retracement, we understand that price can be trading, right, in a bearish trend, creating lower lows and lower highs. So on a smaller time frame, in this previous area of accumulation, because that's what this is, this last push down before it broke structure, this is a previous area of accumulation. So when price comes into here, you want to wait for that same exact thing. You want to wait for it to happen again. And this is where we get in, right? We enter here, stop loss below the low, and you're targeting a new high. That's your target, is a new high. All right, so this is accumulation, and in here is your reaccumulation, right? This is happening in here, and that's where we execute, right? Now,
A question real quick.
yeah,
You will get in on the you said the second accumulation, I think. And then when there's a new higher low, right?
so you want to be a part of the higher low if it's in a bullish trend, because right now this is all right, coming in a bearish trend,
Mhm.
and then it broke, and now it's switching from bearish to bullish. So if price is going to continue to the upside, you're going to wait for that retracement and see the evidence of reaccumulation again, like this,
Yep.
at that previous area of accumulation. And your first target is going to be a new high, because once it creates a new high, it could just dump, you know? So your target's always a new high when you're playing long.
All right.
So, so this is accumulation and reaccumulation. The reaccumulation is what we call waiting for more evidence, right? When you wait for more evidence, that is what that means, right? Because so many times, right, maybe you've experienced this where you see a break of structure, you see the imbalance and you buy, and it just keeps trading lower, right? And that is because there was no evidence of reaccumulation, right? This was just a liquidity sweep, and that's exactly why we wait for evidence, because it increases your probabilities and, yeah, it just helps you prevent yourself from taking unnecessary losses. Vice versa, on the other side, is this distribution and redistribution, right? Where price creates higher high, higher low, higher high. Again, it swept this liquidity, right? Take out early sellers, activating buy stops, and then reversing here. Now we have this low and this high. So now we have some distribution taking place. So again, imagine you bought 500 billion, sold 800 billion. If your objective is to take it to the downside, you're going to come back, close these buy orders, and add on to sells. So now seeing this range, this being the low, this being the high, now it's being bearish. We would anticipate this move up to be that retracement, also known as a bullish counter trend, coming in a bullish trend. And once it gets into this area, you're going to anticipate and wait for that evidence of redistribution within that previous area of distribution. Once that presents itself, your first target is a new low. All right, so that's redistribution now. Do you prefer to see type 1 or 2 on a reversal? It doesn't matter. We're going to go over multiple examples on the charts of type 1 and type 2. Are you waiting for the reaccumulation on the same time frame as the break of structure? It can happen, but more often you're going on a smaller time frame in that area. right? So yeah, that's distribution, redistribution, and of course, this is accumulation, reaccumulation. Now, where can you anticipate these things to happen? Now, we look for, all right, this is very key. We look for accumulation below previous lows, right? And we look for a distribution above previous highs. We look for accumulation and reaccumulation at previous areas of accumulation, also previous higher lows. And then we look for distribution and redistribution at previous areas of distribution and previous lower highs, right? Now, what I mean by that is, it's upside down. Is whenever we're in a bullish trend, give me 1 second here. So when we're in a bullish trend, you want to look for that. Let me draw it over here. Let's bring it over here. Right, when we're in a bullish trend, you want to look for that accumulation and that reaccumulation at the higher lows, right? You want to identify that current range. So you see this is higher high because it closed above this high. This is higher low. You want to see it like this. This is that previous push down. This is a sell, it's a buy. So if you want to continue taking it to the upside, identify that imbalance. Price comes back in a bearish counter trend. You understand this is a retracement until it closes below that previous higher low, because I never really know, right? We never know, like, if after it creates a new high, if it's going to come back and continue to the upside, or if it's just going to dump and, you know, create a low and turn it into bearish. So this is why we wait for evidence. So this is considered a previous area of accumulation. This entire push down before price creates a new high. This is a higher high, higher low. So we're bullish. So this can be considered a retracement coming in a bearish counter trend. Once price comes into this previous area of accumulation in here, you can start to anticipate that either type 1 accumulation with the reaccumulation or type 2 accumulation, right, with the reaccumulation. Now with type 2, I have to go over that in here. Type 2, whenever it sweeps liquidity and you get that reaction and it leaves behind imbalance, it's the same thing for me. I need to see this in here, right? I need to see that within this imbalance, because what that's showing me is an unwillingness to trade lower, right? Whenever price sweeps a low, it gets an impulsive move into the opposite direction and it leaves behind imbalance, I follow this as a counter trend and I only go long if it shows this type 1 accumulation within this imbalance. Because for me, that's indicating an unwillingness to go lower and that price wants to continue trading to the upside, right? So at previous areas of accumulation, also known as at previous higher lows, we're looking for evidence of reaccumulation to continue trading to the upside. And our first target is always a new high, right? Now, again, in a bullish trend, we understand that we are bullish and the higher probable plays are looking for buys. But also, we'll get into that after this. So in a bearish trend, your highest probable scenarios are playing that redistribution, right? So whenever the market's bearish, lower low, lower high, you see that previous area of distribution, which is that last push up before price created a new low. You identify that imbalance throughout that expansion because the imbalances are going to be left whenever that expansion happens. So again, you're anticipating that accumulation below the lows to create a bullish counter trend and retrace in a bullish counter trend into that previous area of distribution. And once it comes into that previous area of distribution, there's no trade for me unless I see this evidence of redistribution, either type 1 or type 2 evidence of redistribution. And once that evidence presents itself within this previous area of distribution, targeting a new low, right? That's the first target. Right, same thing here, market created lower low, lower high. Now this entire push up becomes that previous area of distribution, right? You identify that imbalance right here. Boom. So as price is bearish, you anticipate accumulation below the lows, previous lower high, lower low, previous area of distribution, imbalance. Price would be coming in a bullish counter trend. If you see that evidence of redistribution within that previous area of distribution, then you're going to target a new low and be a part of that next expansion, right, to the downside. So vice versa, again, whenever it's bullish and you have this range, you have a new range, higher high, higher low. This push down is a previous area of accumulation. Once price retraces in a bearish counter trend and you see evidence of reaccumulation within that previous area of accumulation, that is your indication that price is getting ready for that next expansion to the upside. So once you see this evidence of reaccumulation at this previous area of accumulation, you're going to be targeting a new high, right?
So in an example like this, you would always wait for the type 1 accumulation.
No. So you could, it depends, right? It's either or, whatever presents itself. So here you just understand that this is a previous area of accumulation, and when it's retracing, you want to see a significant liquidity sweep in this area where liquidity gets swept and you see either type 1 accumulation or type 2, and then you wait for that evidence of reaccumulation within that area.
Can you show maybe on the example of the DAOs from last Friday? Because they were super clean. Maybe
I could go.
It'll be easier.
Would love that.
No, yeah, we're definitely going to go over a lot of examples right now. Let me see. I'm just responding.
Today was a little slow, but
one second. Okay, yeah, so this is literally how I see it. Right? Now, what's very important to understand is that there's so many opportunities and you can hedge like the banks, as they say, right? People say, oh, trade like the banks, blah, blah, blah. Like really, like for real. So here, understanding the nature of price action, again, let's go back to the scale, right? You're buying below 50%, selling above 50%, right? So imagine that here. This is your, I'll do it in a different color. You can't really see it. This is literally what we're up there, right? Imagine this is 1, this is 10. Your 50 right here. So again, above 50%, you're looking for what? Distribution. Below 50%, you're looking for accumulation. Below 50%, you're looking for accumulation, right? If this is, again, scale of 10 to 1, below 50%, you're looking for accumulation. So again, where do we anticipate distribution and accumulation? We anticipate distribution above previous highs, which is here. You see, we created a new high. We got distribution here, created a new high. We got distribution here. Accumulate lows. You see, this is a new low, got accumulation here. This is a new low. We got accumulation here. And it's just understanding if you're going against the overall trend that you're aware of that, right? Because you don't want to get married or attached to one side of the market. You got to be aware of both. So here, what you can do is whenever the market creates a new high above this high, you can look for distribution and redistribution. It's getting a little sloppy in here. All right, so you look for that distribution and redistribution whenever a price creates a new high. But your targets, you want to target that previous area of accumulation. That has to be your target. Because what do we know, right? This can just be a short-term sell to come back and reaccumulate, right? Above this high, what's being activated, right? Seller stop losses are being activated. Traders with buy stops are being induced. So again, distribution above highs to take out those late buyers after we just took out early sellers, playing distribution above highs into that previous area of accumulation so that price can continue to reaccumulate and trade to the upside. Now, there's two different things that can happen here, right? Whenever price creates a new high, it can come back and reaccumulate, right? Or it can just keep selling off. It doesn't have to reaccumulate. So this is why we play distribution of highs, because you never really know if it's going to come back and reaccumulate and continue trading higher, or if it's just going to continue selling off. And if you play the distribution above highs and it does keep selling off, well, then at least you paid yourself. At least you're already participated in those shorts. And if it comes back into this area of previous accumulation, you could pay yourself on those shorts and, of course, add on to the longs. So that's how you really hedge in the markets, right? Same thing here. Whenever the market's bearish, below previous lows, again, it's being activated. Buyer stop losses, sell stops are being activated. So early buyers are getting stopped out, and sell stops, right? Late sellers. So again, accumulation below lows, you understand it's bearish, price retracing into the previous area of distribution to redistribute, continue to the downside. Price creates a new low below this previous low. We understand, imagine that price range, right? This is 1, this is 10. We're below 50%. We're below a previous low. So we're going to be looking for accumulation below the lows, but we understand the range is bearish, lower low, lower high. So if we're playing accumulation below the lows, our target is going to be this previous area of distribution, because this could just be a short-term retracement for it to redistribute and continue trading to the downside. And if it doesn't redistribute here, there's no shorts. I'm not participating in a sell unless there's clear evidence of redistribution. And if I'm playing the accumulation below the low and I'm in the long and I pay myself here and it doesn't redistribute and it keeps trading to the upside, well, I pay myself on the longs and I'm still in the longs, right? So, so that's that. So not only is it that, right? But it's important to not just rely on structure, right? Because again, liquidity is the name of the game. So what you'll notice is there's different areas where you'll see this, right? So you have your type 1 distribution where break structure comes into imbalance. And then in here, it shows you evidence of redistribution. You have your type 1 accumulation where a break structure leaves imbalance. And in here, it shows you evidence of that reaccumulation. And then you have your type 2 where it sweeps a high, fails to create a high by showing that redistribution within that imbalance gets created after sweeping liquidity. And then you have your type 2 accumulation, where it sweeps liquidity, leaves behind imbalance, comes back, and then reaccumulates here. All right, so failing to create a new low after sweeping liquidity. That's what this is showing. Did someone say something?
Yeah, man, sorry. Do you know why we have a difference in type 1 and 2? Because I always look for type 1. But is type 2 to leave less people involved?
I'm sorry, bro. You like really cut out when you were saying that.
Yeah, you were breaking up as under.
Is type 2 like you hear me?
Yes.
All right. Is type 2 like orchestrated so that less people get involved in the move?
Everything in the world is essentially like orchestrated, like from like every single, that's a whole nother conversation, but the markets are definitely programmed. Like there's an algorithm that's running, and it's probably decades in advance where price is just already set up, and there's just a program that's just being ran. News events that come out are really just an excuse to like move price in certain ways much quicker. But in reality, yeah, for me, I used to just trade this where it was just type 1. And I used to see stuff like this where high, higher, low. I used to wait for it to break and it would never come back. And I'd be like, damn, like that thing just dumped. So you'll notice this happens above highs. And there's another type of liquidity. I can't believe I forgot to mention this. Is the trend line liquidity, right? So many traders are trading with trend lines, putting their stop losses below the low. And then there's also traders who are, again, trend lines here, putting their stop losses above the high. So type 2 is really inducing this type of liquidity here, because you'll notice it doesn't really break structure, but there's liquidity to the downside here. So there's late buyers. And then again, we're trading above a high. So sell stops are being activated. And then these are all the late buyers right here. And then vice versa on the type 2 accumulation, again, late sellers are chasing that trend line, and then that's what gets taken out. And then, yeah, a lot of times it will come back and redistribute, but many times you'll notice the type 2, it's where it just dumps. And that's probably where most people are waiting for the break of structure, and they're just waiting and it never comes back. So that's how you could catch the tops, right? And the bottoms is really just anticipating these certain things, because we're anticipatory traders. Because in reality, what's happening above this high here is also this. This is also happening above the high. And down here, this is also happening below the low. So, so that's type 1, type 2. And then this is very important to understand when it comes to liquidity, and not to just be attached to structure, is again, where do we anticipate, distribution and accumulation to take place? Previous areas of distribution and previous areas of accumulation that haven't been mitigated out of it, right? It's not just lower highs, it's not just higher lows, and it's not just below lows, and it's not just above highs. Well, it is above highs and below lows. So let's say you have a bearish trend, the market's creating lower lows. You see lower high, and you see a break of structure. Now most traders will be like, oh, I'm gonna buy it here, boom, keep going. But again, you have to remember liquidity is on both sides. So what could be happening here is this high is getting swept, this high is getting swept, right? Liquidity is being swept. And again, you see this push up. Now understanding what's happening is that this entire push up is a previous area of distribution. And if there's some imbalance here and this area hasn't been traded into, you can see this as a previous area of distribution. Now, maybe, if you trade a break of structure and stuff, maybe there's been times where you're waiting to buy it in here, even there's imbalance there, and it just shits on that area, right? So this is a liquidity sweep where price is just breaking structure, right, to sweep liquidity, to mitigate out of a previous area of distribution, to continue trading to the downside. And what we look for above these highs is either that type 1 or that type 2 distribution, right? And then same thing here, right? See, it's bullish, right? You're like, oh, it broke structure, right? Most traders will be like, oh, I'm gonna, sell it here. It's gonna keep going lower. But many times that break of structure can just be a liquidity sweep to come back in to a previous area of accumulation to mitigate out of those previous orders to continue trading to the upside. Right? So, and then within this area below these lows, we're looking for that type 1 or that type 2 accumulation, right? So it's not just structure, it's understanding liquidity below lows and above highs. You're looking for accumulation below lows within previous areas of accumulation that haven't been mitigated out of. And you're looking for distribution above highs within previous areas of accumulation that haven't been mitigated out of, right? Because on a higher time frame, price can look like this. And then on a, let's say this is the daily, right? And then like the 4 hour, looks like this. So it's understanding where you are in the range. This is a high, this is a low. Again, 50% right here, below 50%, everything above is liquidity. You can look for liquidity sweeps, right? And then once a low gets swept, you look for that reaccumulation, and then boom, you target a new high, right? Vice versa, it's bearish, price comes back above that 50%, sweeps liquidity, look for that redistribution, boom, target a new low. So I do have another call here in a few minutes, but we're going to hop into some charts and show some real examples, right? So okay. So let's just start with the higher time frame. Okay, what do we see here? Okay, above this high, we have higher high, higher low, higher high, break a structure. What does price do? Again, this is that entire push up, right? That swept liquidity before breaking structure. What does price do? It retraces, it redistributes, sells off. Creates a new lower low, previous lower high. What does price do? It retraces, redistributes, sells off. What does it do here? Lower low, lower high. It comes back, again, sweeps that liquidity, redistributes above that high, and sells off. So it creates a new low. Well, what can we look for below major lows? Look at these lows right here. Look at this imbalance. Look at this previous area of accumulation, which is this entire push down. You can refine that area here. Below this low, imbalance. This is a previous area of accumulation that hasn't been mitigated out of. This entire push down. So what can we look for since we're below major lows within some imbalance in a previous area of accumulation that hasn't been mitigated out of? You look for evidence of reaccumulation. What do we have here? Lower low, lower high, lower low. There's your evidence of accumulation there. Right? Boom. Price retracing in a bearish counter trend. Low, lower high, lower low. There's your reaccumulation, and price just continues to the upside. Right. I know we're going on a higher time frame right now, but it's important that you understand the nature of, the overall higher time frame price action before you start to understand, smaller time frame, how to find entries. You got to understand the higher time frame because it'll help you identify your range, and you want to work from top down. Right. You want to work from top down and be able to, it's like pages in a book, words in a book, like each one is just as equally important because it the whole story just makes sense. So plug this in.
I'm sorry, man. On which time frames do you like to pair them together? Say you restructure an example for the 1 hour, and then you enter on the 5 minute.
Yeah,
Which
all
ones
of them.
do you pair?
All of them. So the thing is, all of them are a part of this picture. So it's working itself down. And I think that's a whole nother lesson when it comes to finding entries. I know everyone wants to find entries and, get those insane risk rewards because that's where you make the money. But it's about understanding price action first before executing. So having a good understanding of the overall higher time frame range, you want to work it yourself down. So you want to go from like the monthly to the weekly to the daily to the 4 hour to the 1 hour to the 15 minutes to the 5 minute. And then, most of our entries are on the 1 minute, the 15-second, and all that stuff. But it's really being able to, have the story in line where it makes sense. So here, what ended up happening is we ended up breaking the structure, right? We ended up lower low, lower high, lower low, breaking structure on this monthly. So now this entire push down is a previous area of accumulation. But also what we did is we swept this high over here, right? So we could look for distribution above this high. And again, from this high, this low to this high is a bullish range. This low could also be considered liquidity. Since it's below that 50%, we could look for a price to potentially come back down and reaccumulate here. But since we're above this previous high, we're looking for distribution above that high. And then this entire push down is a previous area of accumulation. So you'd be looking for reaccumulation out of that area. So again, you see above this high, what do we have? We have all this imbalance, right? And we have this previous area of distribution, which is this entire push up that swept us liquidity before breaking structure, and it left behind all this imbalance, right? Area hasn't been mitigated out of it. So once we trade above this high and we're in a previous area of distribution, we're anticipating more evidence of redistribution. So whenever price comes up, higher high, higher low, higher high, notice it broke structure, right? And then it came up and it swept this liquidity, and then it created a new range, right? And it sold off. Now again, you see all these lows right here, this trend line, all that stuff below major lows in a previous area of accumulation, which is this push down here. You also look for evidence of accumulation if it presents itself, even though we're aware that this current range is bearish. We have this low and this high. So this entire push up is a previous area of distribution. All right, this entire push up right here is a previous area of distribution. And we can see the imbalance that got left behind. Right now, from this high to this low, you see that imbalance is above that 50%. Right, and look what price did. Price came above that 50% into that imbalance, and it redistributed, and it traded to the downside. But also, you look to the left over here, we came into all this imbalance, and we swept all these lows over here. This is what we call playing ping pong, right? We're playing ping pong. We're not attached to just one side. We're playing both sides here. So here, we swept major lows. We came into this previous area of accumulation, right? That hasn't been mitigated out of yet, traded into this imbalance, major imbalance that got left behind right here. And we came down. What do we see? What are we anticipating? In previous areas of accumulation that haven't been mitigated out of yet below previous lows, we're anticipating evidence of reaccumulation. So what do we see? Lower low, lower high, lower low. Again, there's your liquidity sweep. Here's your evidence of reaccumulation. Price comes back. Reaccumulates and continues to the upside. Now, what do we see here? Price reaccumulates. This is the previous high. This is our range, our high, low. Once price creates a new high, what can we look for above those highs? Someone tell me.
Distribution.
Yep, we look for distribution above highs, especially when we're in a bullish range. Whenever price creates a new high, you can look for distribution above that high. But we're aware that we're still bullish. So this is higher high, and this is higher low. Everything else in between is liquidity. So notice how price swept this high. All right, look at what happened once price swept this high. What is this? Is this type 1 or is this type 2 distribution? We swept the high. We got an impulsive move into the opposite direction and we left behind this imbalance. We came back into that imbalance. We redistributed on a smaller time frame. So is this type 1 or is this type 2 distribution?
Type 2.
Yep, exactly. Right. So boom, we swept this high. We left behind significant imbalance. Price came back, and I'll go into it, but literally, this was something we were looking at. And when it came into that area, it gave you the redistribution on the 15-second, right? We're going to do another lesson. I don't have too much time right now, I'll be honest. I got to hop on another call, but we're going to get into all of this, okay? So don't worry. But literally,
free next week, same time.
we could do next week, same time, no problem.
That's dope.
Yeah, so yeah, this is how you catch a place like this, like to the low. That's the 1 to 18, something like. But we were all over this, and then we understand that we're bullish, right? We're bullish. So if this is our current range, higher high, higher low. We understand that this distribution above the high can just be leading to a retracement on to reaccumulate and continue to the upside. So look at this low that got swept. What do we look for below lows and within previous areas of accumulation, which is this previous higher low? Anticipate evidence of besides curse. Exactly. Price is we sweep liquidity. Look at below this low. So below these lows within previous areas of accumulation, we're anticipating evidence of accumulation, of reaccumulation. Well, what do we see here? Lower low, lower high, lower low, broke structure. Boom, there's your trade, right? And we're overall bullish, right? So what are we targeting? A new what?
New high.
A new high, which is right here. So boom, just so there, that's a 1 to 8. Cool. So again,
In this example, would this be your only take profit, or would you take partials?
So for me, exits are important. For me, like this is I guess you could say a final target, but for me, I do it based on percentages. So for me, I pay myself 80% of my position once it hits a 1 to 3. So it's not like I'm holding the full position to this 1 to 8. All right. So I pay myself 80% of my position once my trade hits 1 to 3. And then 50% of that floating position once it hits a 1 to 5. So that's 10% of the total initial position, which leaves me with 10% of my initial position floating. And then once it's at a 1 to 10, I pretty much pay myself the rest. So 80% of my trade at 1 to 3, or 10% at 1 to 5, and then another 10%, 8 to 10% at 1 to 10, depending on what price is doing, and I'll let the rest run. But that's really how you do it. Like you want to pay yourself, like every trade you take throughout the day or like throughout the week, like like I don't like my trades, like you have to pay yourself for showing up. Like if you're in a trade and it goes in your direction, like if it hits your 1 to 3, 1 to 5, like you have to pay yourself. Don't let a trade go that far and not pay yourself. Like that's why we do this, right? So very important. And then after that, what do we see? Higher high, higher low, higher high, higher low, higher high. So we see this right here. higher high, and we're above this high. Higher low. Previous area of accumulation right here. So what are we anticipating? Price to retrace, show evidence.
Accumulation.
Yep, evidence of reaccumulation. So price comes back in area of accumulation. It comes into this imbalance, sweeps these lows. So really, you could just execute here, balance stop below. We like to anticipate evidence of what? Reaccumulation, right? So whenever price sweeps this liquidity, came into this previous area of accumulation, into this imbalance, this is the trade that we took. Came in, low, lower high, lower low, reaccumulated, executed here, stop below that low, or it's a new what? Based off the high frame. A new high, right? So 2 to the high was another 1 to 5. But overall, because we're at this daily range is bearish, lower low, lower high, we understand this could just be a retracement for price to potentially redistribute and continue trading to the downside. So really the main target was this imbalance here. So to that imbalance, that's a 1 to 12, right? And for this one, you know, that's over a 1 to 13 also. And this is a previous area of distribution that hasn't been mitigated out of it. This is that push up, that swept liquidity before this huge sell-off, left behind imbalance. So when price comes into here, we're anticipating potential evidence of what?
Distribution.
Exactly, right? So whenever price came here, I mean, there it is, right? There's your distribution, there's your push up, there's your imbalance, right? In here, it actually did this on the 1 minute. Let's you go and study that. But it did it on the 1 minute in here. So I know where it starts right there. Stop above the high. And we understand that currently on this daily, it was this 4 hour too is bullish, higher high and higher low. So we could be targeting, if we're distributing above that 50%, target back into that 50%. And what's around that 50%? Somewhat. Some imbalance, right? So once price retrace back into that imbalance, this current range is still bullish. We understand this could just be a retracement to come back into this previous area of accumulation to reaccumulate and continue trading to the upside. So once we come into here, I mean, we swept these lows, traded into this imbalance, previous area of accumulation, lower low, lower high, lower low, break a structure, and boom, there's your accumulation below the lows. And this daily is in a bullish trend, higher high, higher low, came into that imbalance, reaccumulated, and we're trading to the upside. So any questions before we wrap this up? I do have to hop on this other call.
So I understand all of this. I personally trade the type 2 was new for me. And I traded like the break of structure on the 1 minute always. That's like my strategy. I'm not really fully getting which time frames to couple which time frames. So now I've just seen you take a few entries on 1 minute, 5 minute. What's in your opinion the best one to look at if you look on 1 minute for entries?
So it's not really about the time frame. It's really about the entire movement, right? You want to see like a strong movement behind what you're getting into, you know? So it's not necessarily one time frame. I need to see it on this time frame and then this time frame. It's really like, am I getting that strong reaction and evidence out of that previous area where there was a strong reaction and evidence before? You know, that's really the footprint in the market that you want to be a part of.
All right. Thanks, man.
Yeah, but I know we could definitely do this again next week, same time, for sure.
Would be great.
Yeah, Chris, I appreciate you having me on, brother.
Bro, thank you for jumping on. Let me actually stop the recording.